Okay, happy Friday out there, Facebook. I'm going to make my second attempt here to hopefully get this live stream going correctly. I was having some technical difficulties. It's the first time I'm using this laptop to go live on Facebook. And more importantly, the reason why I chose to use my laptop is because I'm trying to accomplish being able to share a screen with you guys from my PC so that we can look at an example of what we're going to be talking about today. So today's topic is going to be covering sequence of returns risk. Sequence of returns risk is probably right up there with the longevity risk that we just covered the other day. Sequence of return risk is probably the most misunderstood risk of retirement. And the real reason behind that is because we're taught as we're accumulating our money and saving in our 401ks and IRAs that, really what it boils down to is our average rate of return. And as long as we average, around 7%, then, everything's going to be okay when we start drawing on our nest egg for income, especially if we use our 4% rule that everybody's been educated about in retirement planning. But today we're going to be discussing what sequence of returns risk is and why the 4% rule maybe doesn't really stack up against protecting you from sequence of returns risk. So sequence of returns risk is basically the definition of sequence of return risk is the danger that the timing of withdrawals from a retirement account will have a negative impact on the overall rate of return available to the investor. This can have a significant impact on a retiree who depends on the income from a lifetime of investing and is no longer contributing new capital that could offset losses. So that's the key word here is, when we're in our accumulation phase, when we're still working with our employer and, we're contributing a portion of our salary towards our 401k, when we're entering a down market or we're in a bear market, we're using a method called dollar cost averaging, which basically means we're taking our money and buying stocks when they're low, and that's offsetting the period of time when we were buying stocks at their highest price. So when we experience a loss, we're not really experiencing that loss because of the simple fact that our money is buying more shares when the price is low, so it ends up averaging out, and that's why they call it dollar cost averaging. The difference here is that when you're entering retirement, it's no longer about the average return. It's no longer about the annual return rate. It's all about the order or sequence of returns. And what I mean by that is it's basically the most important thing of this entire equation is what is the return going to be and when does it occur when we start to enter our retirement phase. And the most negative impacting sequence of returns can be when you first enter retirement. Within the first 5 years, if 3 of those years have a negative loss, it's really starting your retirement out on the wrong foot. And it can have an impact on the longevity of your nest egg and how long it really lasts you in retirement. And the goal of our retirement planning is to make sure that we have a plan in place that lasts your entire lifetime and hedges against these risks, especially sequence of returns risk, longevity risk, and a few of the other risks that we're going to be covering. Now I'm going to go into a screen share here and show you a example of what I mean and exactly what sequence of returns risk is. So hopefully this works. Bear with me. Okay, hopefully everybody can see that here. So what we're looking at is an example of a 15-year period, and this is real data. This is starting with year 2000 and ending in 2014. This is the S&P 500 index and the actual returns that occurred during that period of time. So if you look here, this portfolio started with a $1 million balance, okay? And this portfolio was also using the 4% income rule, which, if you're not familiar with that, basically there's always been a theory of the 4% rule, which means you withdraw 4% of your retirement account as income, and then you adjust it for inflation in the future. So you'll see the first year in 2000, there was a $40,000 withdrawal. That was 4% of that $1 million. Now, if you look in the third column, which says return and it says actual, you'll see the first 3 years, 2000, 2001, and 2002, there was a negative loss, negative 10.14, negative 13.04, and negative 23.37. And then to the right, the next column to the right, you'll see the portfolio balance. And that balance is attributing that loss and the withdrawal for income during those years. So you'll notice the portfolio balance in 2000 was $858,000, and then the following year it went down to $705,000, and then the following year after that it went down to $499,000. Now you can go on and look at the additional years there, and you see that there were some positive returns, and then a few years there was another negative drop. That was 2008. And then positive gains again, and then you can look at the portfolio balance to see the ending balance in year 2014 was $273,000. Now here's the thing that I want you guys to really focus on, is look at the very bottom where it says average return in bold numbers. You'll notice that both columns here, both of these returns, these segments of returns, these 14-year periods, both have a 4.07% average rate of return, or annual rate of return on average, okay? Now, if you look at the second to last column on the right where it says the return, and in the parentheses it says swapped, this is exactly the same data, okay? The same data that was used, we just swapped it. We just basically mixed it up. And this is a perfect example of what the random sequence of returns risk is. So you'll notice in the first 3 years, this portfolio on the right didn't experience a loss. It had a 13.41% gain, a 29.6% gain, and then 11.39% gain in the first 3 years. And you'll notice even with drawing down 4% for income, the portfolio balance continued to increase. And if you look, you go down and you notice that the loss years were at the end of this period. So at the bottom 3 years there, it's a negative 10.14, negative 13.04, and negative 23.37. And the ending portfolio balance was $890,871.27. So this is a prime example. This is the same numbers, the same exact returns, just swapped in a different order, and you can see how much of an impact it can have on your portfolio balance. Now, the one thing that I can guarantee you is if you do have a financial advisor at this time or a broker, they don't have a crystal ball, and neither do we. And we can't see the future, but what we do know is that today's market is a very emotional market. And what that means is the stocks are traded and sold and bought off of verbal triggers, things that the president says, things that the Fed says, things that the China or a trade war, things that are said in those conversations. Things that are said on the news. I mean, all of these things factor into the volatility of the market. And if you look at the market, you'll notice it's been nothing but a roller coaster the last handful of years. And it's all because it's an emotional market. And that's not a place for your retirement income to be. And so our solution to that, and one that I hope you can find confidence in, is that when it comes down to retirement planning, we take your income completely out of this equation. We don't want it to be in this volatile market. We want to be able to make sure that your income is safe and that your income is consistent and predictable. Because retirement is all about making sure that you can do what you've set out to do and what you've dreamt of doing in retirement. And the only way to really do that is to have your income stream guaranteed and making sure that it lasts a lifetime. And with with your investments being in the market and riding that roller coaster in retirement, you have to understand how will that make you feel in retirement or approaching retirement. And you're constantly checking the stock market, you're constantly looking at the news, and you're seeing the ebbs and flows of the market. And when that drop happens, your heart drops with it, and you lose a little bit of sleep at night. Imagine going into retirement with all of your cost of living to live the lifestyle you want to live, guaranteed for life with no volatility, meaning you're not going to have to worry about spending less. You're not going to have to worry about losing income. And that is the biggest difference. And that is the difference that we provide our clients. And, we really are confident in our process of doing that. So, again, as I said, it's really all about the random sequence of returns. We don't know when the market's going to do what it does. And there's no real way to hedge that risk. So that's why we make it a guarantee, where we put your income in a vehicle and a product that will guarantee that regardless of market conditions, your income in retirement will be there every single month. So I'm going to close out with, a lot of times people will say, well, the market's doing really well right now, and, I don't think it's the time to leave the market. Here's the thing. I'm not saying you should leave the market. All I'm saying is that you should secure your income outside of the market. You need to put that income and lock it in and guarantee it. And the other thing you have to think about is, we've been on the longest run of a bull market in history. And that just happened a couple weeks ago. We hit the longest tenure of being in a bull market, an up market. And, I'm not one to be negative. I'm definitely not a negative person whatsoever. I'm very optimistic. But if you look and study history, especially in finance, you'll notice that bear markets happen just about every 3.5 years. And while we haven't had one happen in, the last, 10 years or so, what that tells me is that when the next bear market does happen, because it will, it may be a big one. And I just want to make sure that, we're educating people on how they can secure their income in retirement, so that if that does happen, that doesn't have to be a worry for them. And so I hope you guys have gotten a lot of value out of this, and I hope that you're able to take a little bit of this information in and ponder on it. But really, it's all about having a plan, and a plan that really combats and withstands these financial risks retirees face today. And sequence of return risk is one of the top risks that we need to have a plan for. So if you guys have any questions, leave a comment here on our Facebook page. We'd be more than happy to answer it for you. We hope you guys have a wonderful weekend. Make sure that you go out, spend a lot of time with friends and family, and enjoy that nice weather out there. Hopefully it'll be a good weekend for you. So we appreciate you guys tuning in. Hope you guys have a great weekend. Thank you so much. We look forward to serving you in retirement. Thank you.